Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. Well, continuing our discussion about the yield curve and looking at, once again, being in this still the question of steepening or rates coming down, waiting for the Fed's announcement next week as to what they're going to do tapering-wise. From last week, we talked about the psychology of the depositor. And that got me thinking, because one of the things that community bankers are concerned about is that when these rates start to move up on the short end, is that money will move out of the cash type deposits, which include your checking, your savings, and your now accounts. And a lot of them are putting those kind of assumptions into their models of having a large amount of that money move back into CDs. Well, I wanted to look first at what has been the trend in cash type deposits for community banks around the nation. And it has really been spectacular in here in terms of the move up. Can you imagine the cash type deposits were actually below 50% back in 2008 and have moved up throughout the financial crisis, moving up to close to 64% of deposits now. When you look at that, is that you've seen a decline in cost of funds in here. In the most current quarter, a couple of basis points, but when we talked about this a number of webcasts ago, what it did is it kept the national benchmark's net interest margin flat instead of heading down because of the drop in yield and earning assets. Over the last year, what it's done is it's dropped the cost of deposits 22 basis points in here. So it's had an effect in terms of lowering community bank cost of funds. But with this big upsurge, how much of this money came out of CDs and is sitting in like money market accounts right now? Most bankers would agree that a lot of money moved out of CDs. Well, the premise I want to put to you when I talked about the fact of the psychology of the depositor, that essentially the depositor, the typical CD depositor, always thinks that interest rates are going to move up. So when we think about it, is that this may be a large change in that type of deposit, in that type of depositor psychology added into those cash type deposits. So when we think about it, that as interest rates on the short end start to move up, will that person, because they always think interest rates are going to go up, will they move into a longer term CD? And I believe that essentially this may not happen at the rate that a lot of community bankers fear because of that psychology. Because what you'll see, of course, is an upward pricing in terms of those money market rates, albeit it'll be slower than other interest rates, but still bankers will nudge that up over time. The people in that account are like, well, I'm getting a higher rate of interest. Why take the risk of going out when interest rates may go higher? So this may be, as I said, a big change in the culture for community bank deposits. That community bankers may find that because of that psychology, that those depositors that used to be CD customers could be cash type deposit customers for longer than you think. Have a great week. This is Jay Brew, co-chairman of Seafried and Brew.